Welcome back to Algobot, where we break down automated trading strategies for MetaTrader 5 in plain, practical language. I'm your host from Algobot, and today we're examining an expert advisor called Boundary Fade Scalp Hedge. This is a pure price action system. It uses no indicators at all, no moving averages, no oscillators, just raw bar highs, lows, and candle wicks. Over the next several minutes, you'll learn how it fades the edges of a quiet range, how it manages a recovery hedge when a range breaks, and how it banks the whole basket as one. Remember, this is educational content only and not financial advice. So what exactly does Boundary Fade Scalp Hedge do? At its heart, this expert advisor behaves like a hand-managed reversion book. It watches a small, quiet price range and treats the two edges of that range like elastic walls. When price pushes into one edge and then snaps back, the strategy fades that move, meaning it trades in the opposite direction, back toward the middle of the range. Because there are no indicators involved, every decision comes straight from the price chart itself. The highest highs and lowest lows over a look-back window, the length of a candle's rejection wick, and the floating profit or loss of whatever is currently open. The natural home for this approach is a liquid, range-prone foreign exchange major, such as Euro, US dollar or Australian dollar, US dollar, on a 5-minute or 15-minute chart. Those are the conditions where boundary rejections happen often and where a quiet range can persist for hours. There are really two personalities inside this single robot. The first is a scalper that fades the boundaries during calm conditions, aiming for small, quick moves back toward the mean. The second is a recovery layer that activates only when a range genuinely breaks and the fade ends up on the wrong side of a sustained move. Instead of simply absorbing that loss, the strategy opens a larger opposite position in the direction of the breakout, and then manages both positions together as a single basket. Who is this style suited for in an educational sense? It's aimed at traders who want to study range behavior, rejection candles, and basket-style money management, and who understand that hedging systems carry their own particular risks. It is not a hands-off solution, and like every strategy, it can and does produce losing trades. Throughout this video, we'll keep everything framed as analysis and education, never as a promise of any outcome. Let's walk through the mechanics step by step. The strategy operates in 3 states: flat, engaged, and basket management. When the expert advisor is completely flat, it first measures the micro range. It looks back over a set number of closed bars, 24 by default, controlled by the RangeLookback parameter, and records the highest high and the lowest low. The midpoint between them becomes the mean, and the distance between them becomes the range width. Almost every other calculation is expressed as a fraction of that width, which is what lets the strategy self-scale to any symbol or time frame. Next, it examines the single bar that just closed, looking for a boundary rejection. For a long signal, 3 things must line up. First, the bar must dip into the lower edge zone, meaning its low reaches within the edge fraction of the range bottom. Second, it must print a meaningful lower rejection wick, by default at least 40% of the bar zone range, set by the rejection fraction. Third, it must close back inside the range, above the lower boundary, with price still sitting in the lower half. When all of that is true, the strategy sends a market buy. The short signal is the exact mirror image at the upper boundary, producing a market sell. Each fade carries 2 protective levels. The take profit is placed toward the mean, at the scalp TP fraction of the width, which defaults to half the range. The stop loss is placed wide, beyond the boundary, at the scalp SL fraction of the width, by default 1.2 times the range. Now the engaged state. If that lone fade runs against us by the hedge trigger fraction of the width, 60% by default, the strategy treats the range as breaking and opens a larger opposite position in the breakout direction, sized by the hedge multiplier, which defaults to 1.5 times the fade. Finally, the basket layer governs all exits. The instant the combined floating profit reaches the BasketTpMoney value, every position is closed at once. And if the combined floating loss reaches the BasketSlMoney value, everything is flattened. There is also a maximum spread filter that blocks new fades when costs are too high. Let's look at the actual MQL5 code as it appears in MetaTrader. At the top, you can see the input parameters that drive everything. RangeLookback sets how many closed bars define the micro range. Edge fraction and rejection fraction shape what counts as a valid boundary rejection. Scalp TP fraction and scalp SL fraction set the take profit and stop distances as multiples of the range width. Hedge trigger fraction and hedge multiplier control the recovery layer, while BasketTpMoney and BasketSlMoney govern the combined exit. Lots is the base volume. Below that is the long entry block. The strategy builds 3 checks. Poked low is true when the signal bar's low reaches into the lower edge zone. Low reject is true when the lower wick is at least the rejection fraction of the bar's range. And held inside confirms the close finished back above the lower boundary. When all 3 are true, and the ask is still below the midline, it computes a take profit above the entry and a stop loss below it, then calls trade.buy with those levels. The short entry block is the mirror image. Poked high checks that the high reached into the upper edge zone. High reject checks the upper wick, and held inside checks the close stayed below the upper boundary. When those align and the bid is above the midline, it places the take profit below the entry and the stop above it, then calls trade.sell. Notice both sides use the same mathmax guard, which keeps the stop and target a safe minimum distance from price when the range is very tight. It's clean, symmetrical, and entirely price-driven. Now let's bring it all together on the chart. What you're seeing is a quiet, sideways market. Exactly the environment this strategy is built around. 2 horizontal reference lines mark the edges of the micro-range that the expert advisor measures. The upper boundary, the range high, sits at 1.0900. The lower boundary, the range low, sits at 1.0840. Halfway between them is the range midline at 1.0870, and that midline is the magnet the strategy fades toward. Watch the first several candles. Price drifts down from the midline, ticking lower bar by bar, but staying comfortably inside the range. None of these candles qualify for a trade yet, because the strategy is waiting for one specific thing, a rejection right at a boundary. Then it happens. Look at the candle that dips into the lower edge zone, pushing down toward the range low at 1.0840. But notice the long lower wick. Price probed below, sellers couldn't hold it there, and the bar closed back up inside the range, finishing in the lower half. This is the boundary rejection the strategy has been waiting for. All 3 conditions are satisfied. The low reached the edge zone, the rejection wick is long enough, and the close held inside. On the next bar, the expert advisor sends a market buy. That's the buy entry marker you see here. The stop loss is placed wide, well below the range low, and the take profit is set toward the mean. Now follow the next few candles. Buyers step in, and price lifts steadily off the lower boundary, climbing back up through the range. Each rising candle carries it closer to the target. Price reaches the take profit marker just past the midline, and the position closes for a small scalp gain. That's the core idea. Fade the edge, ride the snapback toward the middle, and bank it quickly. After that exit, price keeps drifting higher, now heading toward the opposite wall. Watch as it approaches the range high at 1.0900. A candle pushes up into the upper edge zone, testing the ceiling. But again, look at the wick, this time a long upper wick. Price poked above, buyers failed to sustain it, and the bar closed back down inside the range, finishing in the upper half. That's the mirror image rejection at the top of the range. The high reached the edge zone, the upper rejection wick is long enough, and the close held below the boundary, so the strategy sends a market sell. That's the sell entry marker. Here the stop loss sits wide above the range high, and the take profit is set below, back toward the mean. From there, watch price roll over. Sellers take control, and the market eases lower, candle after candle, away from the upper boundary and back down through the range. Price reaches the take profit marker near the midline, and the short position is closed for another scalp move. 2 trades, both fading a boundary, both targeting the mean. Now, what isn't shown on this COM chart is the recovery layer, so let me describe it. Imagine that after one of these fades, instead of snapping back, price simply kept going, straight through the boundary and out of the range. Once that adverse move reaches the hedge trigger distance, 60% of the range width by default, the strategy would open a larger opposite position in the breakout direction. The original fade is then left to close on its wide protective stop, while the bigger recovery position follows the new move. The whole basket is closed the moment its combined floating profit reaches the basket target, or flattened if the combined loss reaches the basket ceiling. Quiet ranges are handled by the scalp. Genuine breakouts are handled by the recovery hedge. So that's the Boundary Fade Scalp Hedge expert advisor from start to finish. We covered how it measures a micro range from raw price, how it fades rejections at the upper and lower boundaries with a quick target toward the mean, how it activates a larger recovery position when a range truly breaks, and how it manages everything as a single basket with money-based exits. Remember, everything in this video is educational information only. It is not financial advice, not a recommendation, and not a solicitation to trade. Every strategy carries risk, and losing trades are a normal part of trading. If you found this breakdown useful, please like the video, leave a comment with the strategy you'd like us to analyze next, and subscribe for more MetaTrader 5 strategy analyses. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.